This is Power Trading Radio Live. Power Trading Radio Live, fueled by Online Trading Academy. For more information on the show, visit us online at powertradingradio.com. Now, here's your host, Merlin Rothfeld.
Hello, everybody. Welcome to Power Trading Radio. Merlin Rothfeld to you for your Thursday edition. That's right, it is Thursday, folks. We had a great webinar this morning. Thank you for those that joined. A little bit different set. You know, here we are in our big studio, but we have another studio downstairs. We thought, you know what? Let's mix it up. Let's try a different studio setting. I enjoyed it. Hopefully, you had a good time as well. I know it was different than what we normally do, but it was nice to convey that information. And for those of you who are looking for that webinar and didn't get a chance to attend this morning live, of course, it's archived. You can go to otacademy.com under webinars, and you will see it posted there as well. So I'll go to some excerpts from that today. There's a couple pieces I wanted to dive deeper into, which really were more about the rates of return under different administrations. So let me start off with not that. I'm starting off with the top 7 markets. That way I can run through that, we can keep that little snippet, and then move on to something else. So as a change of plans, I mentioned that Larry Jacobson will not be our guest. He's on an airplane right now, but we will have a great guest today. I'm actually pretty excited. We'll have Bill Addiss on the program. Bill's going to talk to us about interest rates. Of course, he's one of my favorite bond guys out there, the most dedicated bond dude that I know. So we'll have him on the phone talking about bonds and interest rates, yields, repo markets, etc. If you have questions, send them on in to powertradingradio.com. Click the button that says Power Blast, and those will all come to me here in the studio, and I'll answer them as we progress through today's show. That said, let's get started. TJ, bring up our top 7. Starting at the bottom, and we know it's always at the bottom or the top. Doesn't seem to find itself in the middle of the pack. Bitcoin, the B to the T to the C, is down today. Well, not a huge down day. It was down 0.26%, so that's your worst performer. And you know it's a good day when the worst thing is down 0.26%. It was a $19 slide, pretty much a yawn snooze fest out there. 7,188 is where it is at right now for Bitcoin, and again, that's your worst performer. Now, it does get significantly better when we start looking at our number 2 finisher, which was the GC. Gold today rallied up dead into that supply zone, which we're probably going to delete that now because it's just exhausted. My guess is the next up move on gold will rip right through that 1495 mark and challenge that 1500, probably hit that 1511. So we bounced up into it again today. It did hold, which is a good sign for anybody who's playing off supply and demand levels. But it is definitely getting weaker and weaker. Gold today was down ultimately at the end of the day. It was down 0.06%. 1474 is where it closed at, a slide of 90 cents per ounce for gold. So a nice intraday move for gold, to be sure. That was number 6. Number 5 brings us to the Nasdaq. Here's your Nasdaq 100 futures chart. On the day, the Nasdaq was actually showing great moves, and lo and behold, we talked about this yesterday, said it still has some room to get above, some levels it's got to clear, some points it's got to break through before it gets to all-time highs. Hallelujah, hallelujah. Here we are at all-time highs yet again. Nasdaq 100 broke through that. You can see, got 8,500 as a print there. That's our mark on the side of the screen. Did it actually get there intraday for the Nasdaq 100? No, not quite. 84.97.5 or 84.97 was our high print for the Nasdaq 100 futures. So that 8,500 mark playing a nice round number psychology supply level. We were at 8,717 for the composite, which was up 0.73% or 63-point gain. All in all, an all-time high, all-time intraday high, etc. No shocker here. We've been talking about that. It just seems to be the new norm. Buy the dips, and here we go to a new high. All right, number 4. Of course, that's trade war stuff. Crude oil. Normally, you would think we go to the S&P, but no, it's going to be crude oil. Here's your CL, which also breached some recent levels, although it wasn't as convincing as we saw with the Nasdaq. Crude oil was up 0.78%, 46-cent increase to $59.22, and that is where it's at right now. All right, keep moving up the list. We go to the podium. It's the Russell 2000 that brings in your bronze medal. 1,645 is where it is at this exact second. That's a gain of 0.79, just eking out crude oil for the podium spot. It was almost a $13 move to the upside. Now, before you celebrate and start thinking how great this is and how amazing it is because we're at all-time highs, we're not at all-time highs on Russell, guys. Just look at the highs here from back in September. Back in September, we were nearing that 1746 mark. Right now, we are considerably lower than that, but all in all, a great day. Breakout, rally, came off its highs a little bit, but still posting some nice gains. Okay, S&P 500. Trade war resolution. Scammell says trade war resolution for Christmas. 100% no, guaranteed not. I'll bet you any amount of money on Scammell. Guaranteed 100% no. Bet any amount. I'll shake on it right now. By Christmas, we will not have a total trade war resolution. we will have a piece of it resolved. And the only reason we're having a piece of it resolved is to make everyone feel all warm and fuzzy for Christmas. We still have a long way to go before there's any solid resolution on it, but feel free to wager anything you want. All right, S&P 500 here was your number 2. 0.86, it also looks great, way better than Nasdaq in my opinion, because the way the candle ended the day, strong bullish formation, ended near the highs, certainly off a little bit here, but we broke through all-time highs, all-time closing high, all-time intraday high for the S&P. 3,168 was its final number. Again, 0.86% move to the upside. All right, but that's not your best performer. By a long shot, that was going to be the 10-year. Now, you look at this big, ugly red candle. That's because the yields were spiking today. You had almost a 6% gain, 5.98% yield spike. That's 0.107, which brought it up to 1.897. Remember, just a couple days ago, we were down at the 1.7 and change. Well, today we are coming right back down to these lows, which is going the exact opposite way I thought they would go, which is fine. Hey, I'm wrong a lot. It's okay. But we're coming right back down to those lows we saw from early November on this 10-year Treasury note. Again, that means yields are spiking, and we are back up to 1.89% on that 10-year Treasury yield. So there you go. That's your top 7 markets. Hopefully one of those put some green in your pocket today. I'm going to go to a little bit different type of question here. Unscammable sent this one in, and it's an odd question that most of you really don't care about, probably won't matter to you, and is not going to be impactful to your trading, but I'll do my best to cover it. It has to do with the rule called the 10b-18 rule. Now, there's tons and tons of SEC rules out there in the marketplace which are designed to protect individual investors. This one actually is designed to protect the firms that are doing share buybacks, because there's a belief out there that many of them are manipulating their share price by doing buybacks. So there's conditions that some companies should follow to get a safe harbor, meaning they have some protection under the law. Now, it breaks down to 2 things: timing, price, volume, and the manner of how they purchase it. The only time that 10b-18 rule is really going to be impactful is for a company that's got low liquidity or a low float. Most companies are doing share buybacks all the time. For example, yesterday, was it yesterday? I think it was the let me get the exact date. I think it was on the 3rd, so a week or so ago. MasterCard announced they were going to do an $8 billion share buyback. $8 billion buyback, not 8 billion shares, $8 billion buyback. Now, in theory, when a company does a buyback, what should happen to the price of that security? It should spike to the upside, because they are taking those shares, removing them from the float, which all of a sudden artificially modifies your earnings per share, because there's fewer shares. You have the same amount of earnings. Now all of a sudden your EPS starts to rise. So it's a way to bump your numbers and legally, not with an I, but illegally cooking the books is really what they're doing, and artificially modifying their earnings per share. So that's what's happening with companies like MasterCard. Now, MasterCard's float is so massive, and also their volume is so liquid, that they don't follow these rules because they're not so concerned with it. They're not concerned that they have to buy everything on the same day they make the announcement. That's really going to be for illiquid companies. To the other point here, these announcements, these share buybacks, when you hear it, it makes you think, whoa, these companies are going to buy back billions of dollars worth of stock. It's going to go through the roof. It's going to spike. In theory, yes. But let's be clear, last year on December 4th, MasterCard did what? They made an announcement that they're going to buy $6.5 billion worth of shares back. They still haven't finished. They still have $300 million left. And this new $8 billion, which was announced a couple weeks ago, they'll probably take the entire 2020 to buy those shares back. So it's not going to significantly impact those share prices like you think. On a low liquidity stock, sure, it's going to have a big move. But companies like Cummins, who also announced a share buyback, they've been doing like $2 billion a year. They announce it every December. It's now part of the routine and the rotation that they typically do. Now, how does this work? There's a lot of different ways we can do share buybacks. I'm not going to get into all the minutia of it. I know that on Unscammable, you were thinking, well, it's going to spike those prices. You're right here in your comment that you say, I think that 10b-18 only helps the indexes in reality. No, it certainly helps the company. But trying to time that purchase with that announcement, that's a fool's errand. I mean, let's look at MasterCard's share price, TJ. Bring up MA, and we'll take a little peek at what happened here. Here's MasterCard. I'm going to put a cursor on when they made that announcement. The vertical line that you guys see right here is when they made that announcement, which was December 13th. Now, of course, it has moved up since then. But the markets are also at all-time highs and ripping through to the upside, right? So yes, if this is a component of an index, certainly it would help over time because its value would most likely go up. Now let's go back to December of last year on MasterCard. TJ, put a cursor on December, I believe it was December 4th of last year, which we can say was right, keep going, a couple more, one more, there you go, right there, right? You guys see the vertical line. That's where they made their announcement. Notice that it fell. It fell from 203 all the way down to 172. You're talking a $30 slide in the price of MasterCard stock, even after they announced a $6.5 billion buyback of shares. Of course, look what happened to the price. We could say that's because of share buybacks. We could also make the assessment that this is because of just one hell of a bull market. Now, there are, and Scammell says there's so many small companies doing 10B, 18 share buybacks. Yes, they are. But I don't think that it's that critical to follow them. I've never personally experienced when somebody says doing a share buyback, me riding the coattails of that announcement and all of a sudden seeing a big pop in it. So 12B18 is simply a rule that protects the small companies because usually they're buying a large block that could manipulate the float, manipulate share prices, and of course those shareholders would be like, oh, you manipulated price, blah, blah, blah. Doesn't usually happen with the big ones. Like I mentioned, Cummins has made an announcement recently. They're doing $2 billion a year. It happens all the time. But yes, you are absolutely right on Scammell that this is a way to cook the books. This is a way to continue to inflate prices because you're removing shares from supply. Therefore, you have the same amount of dollars chasing a lower amount of shares. Price is going to go up. You also have the artificial manipulation of the earnings per share numbers. Because if I make $1 million and have 1 million shares, I'm earning $1 per share. But if I make $1 million and I now have 500,000 shares, I'm earning $2 per share. I haven't made any more money. It's just for fewer shares. So I'm artificially cooking the books. Next earnings announcement, it looks better and better. So if you see MasterCard report the same amount of earnings next year, you got to go, your EPS, this is not good because they're technically losing money because they have fewer shares, same amount of money, EPS should go higher. Anyway, we could go long-winded on this one about how share buybacks manipulate the markets. It's been one of my pet peeves for a long time, but hey, it's one of the loopholes that firms can use, and honestly, if you're a company owner, you should be using to jack your share price, and that, of course, jacks the indexes to all-time highs, which we are experiencing right now. All right, I went long-winded on that one. Thank you for the question on Scammell. I do appreciate that one. Bill Addiss will be our guest. We're going to call him right now, and we'll take a quick break. When we come back, we'll talk interest rate products, talk bonds, yields, repos, whatever you guys want. Send your questions in at powertradingradio.com. Click Power Blast or join the chat. Say hello to everybody. We'll be right back after a short break.
There are lots of different reasons why I teach. I know what it's like from the beginning because I was a student here. I love going around the classroom and you get those aha moments where, slowly those light bulbs switch on as the week unfolds. And for me, it's magical.
I've been telling students for years that I derive professional satisfaction from sharing my knowledge about trading. I grew up on the floor of the Board of Trade. My father was my first mentor.
I like to see people run. And in order for them to run, they need to walk well first. And for me to help them build a solid foundation and then watch them go forward, that's something that money can't buy.
What these people are now realizing is the freedom that they have always wanted to achieve. And it's a quite humbling and honorable experience to be able to know that in some small way I contributed to them.
The students make the academy. And I meet wonderful people from all walks of life, and they always have a story to tell. And the story is always interesting.
Being able to explain things in a way where the light bulb goes off, and that gives me the chills. It's a wonderful experience to see that growth in somebody else and that you're a part of that. It's magic.
The students, I really want to enable them to bypass the challenges that everybody goes through.
There is rather a selfish aspect, and that selfish aspect is I have found more of me as a person. Just a self-discovery.
And in every class that I teach, I get to share my knowledge, and I get to see each and every one of my students learn how to trade in a bull market and in a bear market and even in a sideways market. And each time I see that student of mine take that first trade, it's such a rewarding experience. It's awesome.
Welcome back to Power Trading Radio Live and your host, Merlin Rothfeld, with today's special guest.
Hello, everybody. Welcome back to Power Training Radio. It is your Thursday edition. We're right near the end, and I couldn't be more excited because tomorrow, vacation time for me, folks. You'll have John O'Donnell all next week with a bunch of great guests. I think we'll probably take Christmas off as the tail end of the year rolls down, but I will be out of here enjoying some sunshine. I'll probably come back with a big tan. Then you guys can see my vitiligo and make fun of me, which some of you have done before, but I will let that slide. All right. We have a surprise guest today. As you guys know, I was supposed to be alone in studio today, and I got a phone call or a message today talking about interest rates. I said, hey, why don't you come on the program today? And of course, he's always willing to come on the program and talk the product that he loves, bonds, interest rate products. We've got Bill Addiss joining us today. Bill, how you doing?
I'm doing great, Merlin. I didn't realize I was the swan song before your vacation. That's great.
You are. It's always a pleasure having you on. I'm excited that you could join me today. I mean, it's very timely as well, given what's going on. For those that may not have been paying attention, today you had two major announcements. You had the Swiss National Bank talking about their rate. Came out at negative 0.75, which, that's right, that's a 0.75% percent rate. That is ugly. You also have the ECB come out with their main refinance rate, talking zero out there. No surprises there. U.S. is at 1.75, 1.5 to 1.75, holding flat. So all seems to be remaining still on the interest rate front. Bill, any color commentary or things that you noticed from yesterday or today?
Well, the big news, obviously, U.S. focus was the FOMC meeting,
right.
And it honestly had to be probably the most boring FOMC meeting any of us have ever experienced. There was no surprises. I mean, we like these surprises. We like something.
Yeah.
Even analyzing every adjective and adverb of the meetings, we can't find anything interesting. The Fed things status quo.
You know, it was kind of funny. I had a couple people in my webinar today say, Merlin for Fed chair, and I was just kind of laughing, and I thought about it for a second. I said, you know what? I kind of wouldn't mind that job because I basically get to just repurpose an old essay I wrote months and months and months ago and just go, let me real quickly take a peek at that. Yeah, let's take this word out. You know what? Let's change produce to manufacture. Okay, yeah, let's change that word.
Yep.
There was one thing that I found interesting in it, and luckily I have friends who love to scour this stuff because honestly that bores the hell out of me to read through those statements. But he was saying that one of the ones that was removed was there was a statement about uncertainty, market uncertainties going forward, and that was removed, which I thought was interesting because, let's be honest, there are always market uncertainties. That is what markets are all about. But to remove that from the statement almost makes you feel like the Fed really feels comfortable that there is smoother sailing ahead for our markets to the upside.
I would have to agree with you. And the other interpretation of that was that had actually been inserted in the past meetings, kind of addressing the political uncertainties and, the tweets and tariffs and that sort of thing. So it was almost perceived that this is kind of the depoliticization, if I could pronounce that, of the messages. But it really does bode for clear sailing. The Fed has been incredibly transparent in years past, and they basically said that for next year, barring any unforeseen circumstances, they see no change to rates.
Yeah.
And only the following year, 2021, is a 30 basis point hike over the course of the whole year. So, yeah, they're basically saying smooth sailing ahead. The only caveat that they would add is they want to see more inflation.
Right.
It's kind of unusual for central banks to say they want to see inflation. But we do. We really do. We'd like to see some wage inflation. We'd like to see some price inflation. Why we're not seeing any inflationary pressures, particularly if the wage situation is so good, the employment situation is so good.
Right. All right, TJ, bring up the dot plot here. I have the dot plot, which I had a question about the dot plot yesterday, so I thought I would share with the audience. Something that, honestly, I really don't care about. I don't really, it doesn't really make a big difference to me what the dot plot looks like. This is, if you understand what the dot plot is, you have 17 members of the Fed, 10 get to vote, but really these 17 all get to make their opinions about where they think rates should be or where they would be. And, obviously this is what it should look like. It should be a series of moving up rates. That's a sign that our economy is robust and we're slowing things, using rates maybe to slow it down a little bit, but it also does push inflation, et cetera. I found it interesting that for all of 2020, we had 14 members say keep it right where it's at, which I would find staggering if that happened, and 4 said let's increase by 25 basis points. Up until Tuesday night, the Fed funds futures were pricing in almost guaranteed 50 to 75 basis point cut by the end of December 2020. And all of a sudden the Fed said, no, we're not even considering that. We're thinking raises. And all of a sudden everything shifted dramatically. What do you think? I mean, I know you're not a Fed person. You're not one of the voting members, but you're pretty damn smart. So what do you think is going to happen?
Thank you. Well, I think we've got a little bit of a hypocrisy going on here, quite frankly, because what the Fed is saying and what they're doing are two different things. And I really think that warrants some attention because, the Fed is basically saying we're not seeing ourselves cutting. And in fact, there's the pressure of rates going up. And then the dots kind of point that out. When in fact, what the Fed was doing this week was cutting.
Yeah.
We've had an amazing situation that we've been talking about for a couple of months with this whole repo market situation and the aberrations to short-term interest rates. I mean, just this week, the Fed injected $70 billion of liquidity into the U.S. economy in an effort to get that repo rate down. That's cutting.
Mm-hmm. Right.
The Fed is adding to their balance sheet. If you look, the Fed's balance sheet as of this week is now back up over $4 billion. So not that I would ever accuse anyone in Washington of being hypocritical in any way, but, we've got the Fed saying we're not going to raise rates, we're not going to cut rates, when in fact this week they essentially did quantitative easing.
Right. Let's dovetail into that because you and I have done a lot of videos in the past, and for those of you who would like to know more about the Fed structure, how the Fed works, about bonds, about interest rate products, Bill has done just a tremendous series. I've had the privilege of interviewing him and discussing and learning myself in the process. If you go to otacademy.com and just type in Bill Addiss or bonds, you'll see a ton of free videos out there. I would encourage you to share those. Not only are they great videos, but actually shout out to Gary Christmas and his video team. I don't know if you saw, but they took our interview, which was just slides with some information, and made those come alive with some amazing visuals. So props to Gary and his team both. Thank you, and TJ as well. We've got a visual up here of the Fed's total assets, repos at work. You and I have talked about the systemic risk of the Fed not stepping in and bailing out the repo market. What's noteworthy here on this chart, everybody, is we had roughly $4.5 trillion on the Fed's balance sheets. That's its peak, and that was in 2015. And, they started unwinding. They slowly did a systematic unwind. You can see that slow drawdown from 2017 into where we were just a couple of months ago. And all of a sudden, and actually I think this should have one more bar because if I'm not mistaken, Bill, we're back above the $4 trillion, right? And in assets on the balance sheet?
As of this week.
As of this week.
Literally,
right?
As of this week, we crossed back up over $4 billion. So the chart's going back up again. The Fed's adding to their balance sheet. The Fed is injecting cash into the U.S. economy. They're cutting.
What risk does this pose? Now, you and I have talked about it, which is if the Fed doesn't step in and that repo market doesn't have backers for these assets, then it does potentially pose a systemic problem. So we know the Fed's not going to back out. But under what circumstances is the Fed going to continue to do this? I mean, it feels like they're pressured, that they're forced to do it. Is there another solution? Is there another way that we can kind of keep this machine running without the Fed manipulating things?
Yeah, no, that is a $64,000 question because, we look at that chart that you were showing. The reason the Fed added liquidity to the system, back in 2009 through 13 was because of a credit crisis at the banks. That's not our situation now. What we literally have now is a liquidity crisis. And I know this is hard to believe, but it just says we don't have enough actual cash in the U.S. banking system. We've got a cash shortage. And it's interesting, I'm a bit of an eco nerd, I admit, but the Bank for International Settlements, BIS, which is a very big global, not regulator, but bank organization, they came out with an in-depth study this week they published that just points out they really don't understand why this happened back in September. But they also speculated that it's probably going to happen again at year end. Right. So, and we're starting to see it. As I said, that's why the Fed came in and did $70 billion worth of repo on Tuesday, was to inject more liquidity. So we kind of are seeing it happen. We don't want it to happen. In fact, we can't let it happen. I mean, as repo, we've talked about at length, repo is kind of the financial engine that runs our economy. Most people aren't aware of what this product is, but it literally runs our economy. So the Fed really has no choice but to keep injecting liquidity. But it does reflect kind of systemic risk that we don't really have our hands around as to why it's happening.
Right.
I mean, think about it. It really is hard to believe that the U.S. economy is literally running out of liquidity. So the Fed is forced to step in. And when they started back in September, this is the first time we've had the Fed intercede in the market since the financial crisis.
Yeah, right.
But, as we just said, they're doing it for different reasons.
Sure.
But they still have to do it nonetheless. We can't have banks having to pay 10% to borrow money.
Well, and this is where some of the free market guys would come in and say, yeah, we can. It's just a systemic thing. Yes, it would be horrible, and there'd probably be a crash, but why not let the free markets handle it as opposed to continue to manipulate things?
There is that argument to be made.
You're like, I don't agree with it. But
right. I'll be diplomatic. There is that argument to be made. And, I mean, that would be the same argument that says we don't need a central bank. And there is that argument. I'm not sure. I agree with that, but I can't disagree. There is that argument.
Yeah, a lot of it.
I also would like to reiterate, though, and put in a plug, because the videos you talked about that I worked on with you and Gary and his team did such a phenomenal job on, they couldn't be more timely. I mean, relative to the introduction you just made, one of the videos that was just published today on OTA Academy is on negative interest rates. So explaining what you talked about with what's happening with some of those European rates, what does a negative interest rate mean? The conversation we're having about repo today, which is really critical, but most people don't understand. That video was also just put on OTA Academy today. So really timely set of videos that Gary and his team and you guys did a great job on.
Yeah, no, I love it. I actually love every time you and I sit and get to work on some of this stuff, because it makes me think of a market segment that I don't normally look at. So I appreciate you taking the time to do it. Let's go, where do I want to go here? I had a couple of questions. Let's go back to interest rates. So you talk about rates around the world. We obviously had, Swiss National Bank is at negative 0.75. I think I had it somewhere. I may not have it here with me. No, I don't have it in the studio. But I had some documentation that was showing the different rates. I actually used it in the webinar this morning. And what was interesting is, if you go back to, let's say, 2015, Sweden, the UK, maybe UK's went from 75 basis points to 50, now back to 75, just kind of sitting there. Then you had, you have obviously the euro's been pegged to 0. Japan's at negative 0.1, and it's been there forever. You have, I think, Sweden's negative 0.25. So all of these countries have been basically flatlined for the better part of 4 years. Yet the U.S. over that same period of time was increasing rates, from 0 to a peak of 2.5%. in 2018. Now, of course, in a robust market economy, we want to see rates rising. That's kind of what you should be doing, not to stop it, but just to give yourself more cushion so that when all hell does break loose, which it usually does, you can cut rates real quick and you can help the machine get back on track. So all of a sudden, we're the only ones raising rates, which should have been an eye-opener to begin with. I know it's like keep up with the Joneses type of thing, and we think that we're Jones. We went from 2.5, right now we're at 1.5 to 1.75. What do you think, what do you make of that, where the rest of the world is sitting there at 0 or negative, and here we are raising, and all of a sudden we had to really quickly do an about face in 2019 with 3 rate cuts to bring us down a little bit? Are we being overly aggressive, or do you see these foreign countries actually starting to raise their rates?
I think it's a two-part answer, and if we look at Europe and the other countries that you mentioned, I think more and more economists are coming to the realization or the questioning, do negative interest rates actually work?
Right.
Because, we're looking at kind of classical Keynesian economics, which never even called for negative rates. But, negative rates obviously should act as a market stimulus.
Yeah.
But as you said, you look at a country like Japan, they've had negative interest rates for years. Maybe it's not the economic catalyst that many people thought it would be. Mm-hmm. So I think there's a real question as to, did banks kind of overstep their bounds? I also, though, have to give credit to Chairman Powell, because while he was under intense pressure to be cutting our rates to get them low at the same time, he wasn't. And I think he honestly, as Yellen before him, he had the courage of his conviction, because what it gave the U.S. is we've now got the wiggle room that other countries don't have. Mm-hmm. If negative interest rates don't work, or let's say 0 is not what we thought it was, the fact that we had our interest rates up a little bit higher than that does mean that, if we do go into some sort of a downturn, we've got wiggle room that the rest of the world doesn't have.
Right.
And it also has helped us from the dollar point of view. Because, if we look, a 10-year Treasury at 1.5, although actually today it's up to 1.9. We had a 10 basis point hike in rates today. But if you look at a 1.9, it might not look like an attractive interest rate, but globally speaking, as you just pointed out, it's actually a pretty attractive rate.
Yeah.
So, that's creating demand for dollar-based assets that I think the U.S. stock market is benefiting from, the bond market is benefiting from.
Right.
I don't think that was the Fed's goal, but I think it's certainly one of the ramifications of them keeping our rates higher than the rest of the world. They wanted to give us that wiggle room so that they can cut if they need to. We hope they don't, but we've got room that the rest of the world doesn't have.
Yeah, and this was part of the webinar I did today. It's interesting that you have these countries that are staying at zero or very near zero and maybe even negative. And in theory, it does give them a competitive advantage because you're punishing savers for keeping money in savings. So, of course, you're forcing people to go and spend money, which adds to consumption, which in theory, you would think would help your markets. There's other things out there that are interesting as well. Bill was just talking about the 10-year. And, you can buy a 10-year Treasury note and get yourself 1.89%. Well, if I'm German, and I'm looking at getting, negative 0.2% on a bond, or I can get 1.8%, you can bet your bottom dollar you know where I'm going. And this is what has been part of the problem and fueled our bond bubble, which I talked about today in our webinar, which you can find at otacademy.com. In a bond bubble, it's the underlying price of the bonds are moving up significantly because of demand, right? All these global markets with $17 trillion worth of negative yields are saying, oh, I don't want to buy a negative yield, I'll go somewhere else. Where's yielding? It's the U.S. So keep that in mind. If the Fed continues to raise rates, that of course should impact our Treasury product. Doesn't have to, but it should. That means that you'll probably get more demand for Treasury products, which could further exacerbate this bond bubble. So, it's kind of in the Fed's best interest right now to actually, I hate to say it, to be cutting rates to make the dollar less attractive. Because if the more they raise rates, the more people are going to buy dollars to hold that asset so they can get that yield. So there's a massive chess game that's involving trillions and trillions of dollars at play right now. It's not just the U.S., it's the ECB, it's China. It's kind of exciting and interesting for me to watch all these chess moves and try to make sense of it all. I know you love it as well.
I do. And that demand situation, I just might point out, was even illustrated this week. We had a 10-year note auction this week. We issued $27 billion more of 10-year Treasury, so we brought good supply into the market, but the demand was great. We had 2.5 times as many buyers of those Treasuries as we actually had Treasuries to sell. That's called the bid-to-cover ratio. And that there was really strong demand. And you might say, at a 1.8, which is what it was earlier this week, why such strong demand? For exactly the reason you just said. If every government bond in Germany is now at a negative yield, suddenly 1.8 looks pretty attractive.
Yeah, it's real interesting, and who knows where this goes from here, guys. I'm excited for it. I like the talk track we had today about currency wars, et cetera. I found to be very interesting. Who knows? 2020 will be a great year. I love the comment here from Scott. Scott says, I make money regardless of any direction. And that's exactly the mindset we have to have, right? And I've been trying to convey that to everybody. Don't get so locked in your ways, because we may come to a period where all of a sudden we get just a year of just apocalypse, and I don't think it's going to be 2020, but there could be that time coming, and you can't be set in your ways. Just spin your mechanism and go short those markets if that's what the markets dictate. Scott also asks, it's a good one, he says, where did the cash go? Because you mentioned that the Fed, there's not enough cash. And TJ, if you wouldn't mind, I know you closed it out. I saw you shut that one down. Bring, in a second when we get it up here, bring that one, the Fed's balance sheet at work up for our viewers. Scott, this is where it went. All this money right here, you see this balance sheet disappearing, right? What you have is you have a market, and you can correct me if I'm wrong here, Bill, but what we have is a market that is used to this amount of capital in the system. This is the Fed's balance sheet, over $4.5 trillion. All of a sudden, we found that this money is being removed from supply. So it went from 4.5 down to, I'm going to say, 3.8. Okay, that's $700 billion worth of physical cash, or digital cash at this point, that is being retired and put back to where they borrowed it from. Because all the money that the Fed got for this balance sheets, it was just a digital entry. They created it out of thin air, but the system now is used to it. So when that money disappears from the system's now going, wait, hold on a second. We were working with that capital. Because remember, this bubble, this machine has been getting bigger and bigger and bigger and bigger But now the piece that's helped fuel that growth of size all of a sudden is getting chunks taken out of it every month as the Fed is unwinding their balance sheet. Now, that was my assessment of it. Bill, am I right? And that's where the money went?
No, that is a big part of it. Perfect illustration. Just to reiterate, as the Fed was selling those treasuries, reducing their balance sheet, that was pulling cash out of the system, reducing the amount of cash in the system. So that's why this week they've had to quick scurry and reverse that and start putting cash back into the system by way of buying treasuries, as you see on that little blip, I'm sure, at the end of the chart.
Yeah.
You also have on top of that, and this gets into the regulatory issue, banks now have to set aside more capital as a result of the risks that they're taking.
Right.
What's called the Basel Accord has what we call risk-adjusted capital, meaning banks, to do what they used to do back in 2008, they now have to set aside more capital at the Fed, and that takes capital out of the system. So this is also one of the arguments why people are saying maybe we have too much regulation because the banks literally have to start setting aside so much cash, we don't have enough cash in the banking system.
Yeah. We can make that argument all day. There's too much regulation, there's too little regulation. It's which side do we teeter on that one? But
we don't want to go there, but that is part of this discussion.
Sure.
But I think more importantly, what you're illustrating with that chart is one of the biggest factors. So it's kind of like the Fed is now held hostage. We're kind of junkies to cash in the U.S. economy. We need cash. So the Fed is feeding us that cash that we need by way of buying more treasuries and putting cash into the system. It's basically what we're calling quantitative easing light.
Yeah.
The Fed is doing QE2 kind of surreptitiously, very under the radar screen. But they're doing it nonetheless, as that chart shows.
Well, unscammable, I know you hate this one, but I think you might laugh at this, and it's probably, I think it's rather true, that us, as traders, institutions, these big financial firms, we are all addicts, and our drug dealer is the Fed. So they were taking away our supply. Markets freaked out a little bit. Oh man, you're taking away my goods. You're taking away my goods. And that's it. The Fed is our pusher, and they're the ones that's propping this up. So hey, bless them. They're serving a purpose if you're long and strong right now. But keep in mind that pusher might run out of supply at some point. Bill, tell me about your upcoming schedule. Are you doing anything fun for the holidays? You doing any more teaching for us? You got XLTs? What you got cooking?
No, it's great. I'm doing the weekly asset mastery classes, and those have been going really well. And honestly, they've been kind of the fodder for the videos that we've been doing.
Nice.
So I'm not going to be out to California, unfortunately, until February. We'll have to talk about getting together in February. A busy travel schedule between now and then, but I won't be out your way, unfortunately, until February. But I do have a weekly asset mastery class every Thursday afternoon, and that's been a lot of fun working with your people.
Thursday afternoon. Give me some times here so our members can write it down.
For the AAM audience, it's Thursdays at 4 o'clock Eastern Time, 1 o'clock Pacific Time every week. And I get into kind of the macroeconomics, what's going on for the week, and then Joanne Farley joins us to do supply and demand zones on the products we talk about, whether it's treasury products or credit products. And I would point out, relative to that for just a moment, we had a lot of supply of bonds come into the market this year.
Yeah.
If you look at the amount of credit product that's out there, you talk about we're junkies to the Fed, we're junkies to anybody who's willing to issue bonds and borrow money. So just like the government is borrowing a lot of money, so are corporations. So there's a lot of corporate paper out there as well. So I kind of think the word bubble is well overused, but I think it's kind of appropriate when we talk about a credit bubble that we're experiencing right now.
Well, look,
Tesla.
A bubble doesn't mean it's going to pop tomorrow. It just means we have something that's become overly inflated. That's a bubble, and who knows? Maybe over time it'll just hold there and not pop. Generally what we've seen historically is bubbles do pop, and well, hopefully when that happens, we will all be ready and prepared for it. So, Bill, thank you so much for coming on the program today. I love that you contacted me this morning. It was serendipity. It worked out perfectly. So,
it worked out.
Yeah, absolutely. Well, safe travels. I probably won't talk to you before the end of the year. Best to all you and your family, and I look forward to talking to you soon.
You too. Have a great holiday and a happy holiday to everyone out there in the community.
All right. Thank you, Bill. Take care.
All right. Cheers, sir.
Guys, that was Bill Addiss, one of our resident bond experts, been 40 plus years in the bond markets. He actually, one reason he's not with us full time and working with Untitled Trading Academy teaching physical classes, he does a lot of stuff, I guess not part time, but he does a lot of small lessons for us. Why? Because he's out working with these major financial institutions, teaching them bond markets, et cetera. So it's great to have somebody of his caliber give us some insights. He mentioned he's doing all asset mastery. So for those of you who have access to AAM, you can go Thursday afternoons at 4 p.m. Eastern, 1 p.m. Pacific, and he does a great macroeconomic piece. And I'm assuming some of you probably liked his content today, as I did, which I love having him on the show. Okay. What else? I saw something come in through here. I think this was on All My Trading Academy's YouTube. Yeah, it was. BR says, everyone, I'm finishing core tomorrow. Should I buy into XLT or get my feet under me for a while? I agree with Scott. Just go for the XLT. And of course, I work there, but there's a reason for it. You're basically saying, if you finish a class, yes, you have a lot of information, but if you go on your own and try to process that by yourself in your own environment, a lot of times you start to make mistakes or deviate away from the plan and the structure and the process. XLT is one of those environments where you are practicing what you learned in class every single day, actually going deeper on a lot of those topics, but through repetition, as they say, it's the mother of perfection. Doing that under supervision, not only of our instructors, but also underneath the hundreds of students who are in there, it will help you grasp these concepts much, much quicker. So to me, XLT has been one of those blessings that really help people grasp concepts, understand how to apply them, help you establish your discipline, your rules, your structure, and all that. So to me, I would say go straight in. How much is it? You got to talk to your local center out there about that one. If you want to know more information about All My Trading Academy, the XLTs, the different classes we talk about, such as stocks, options, futures, forex, commodities, you name it, you can go to that link that's showing up in your social media channels right now. If you simply click on that one, you type in your zip code. There are 48 physical brick and mortar schools around the country. Each one has free classes, paid classes, community events, and always covering topics like we discuss here on Power Trading Radio, just much more detail, so you can find out how we might be able to help you with education, understand how these markets truly work, and put them to your advantage. All right, what else do I got? I was going to go into that one. Scott says, when is the Santa Claus rally supposed to start? When does it start, man? Show me the rally. Well, what's interesting if you look back, and I'm glad that Unscamable sent in that 10B18 thing, just because we don't usually talk about it too much on the program because I don't want to go too deep on topics, but share buybacks are a big thing, and you hear a lot of companies announcing share buybacks right near the end of the year. And that is part, I believe, personally, why you see a Santa Claus rally. Certainly we know that usually at the end of the year they're selling off stocks that are underperformers and they're buying ones that performers. So on the books, these fund managers look more intelligent. Hey, I was holding Apple as it went up 50% this year. Yeah, we only owned it for 3 days of the year. From statistics, the numbers, it's literally the last week of December and the first 2 days of January. So it's just like week and a half, that's the Santa Claus rally if you look at it from a historical perspective, but I don't know if I necessarily buy that. That would mean that it's going to go from about December 23rd to January 2nd. Given all the things that are going on right now, I think you'll probably have a different dynamic. I think it may have already started. You've got share buybacks being announced last week and this week for big names. I mentioned Cummins and MasterCard, but there's many others. You also have the window dressing, which will go on near the end of the year. You also have an unbelievably robust retail consumption that went on for Christmas and the Black Friday. I think you have a lot of reasons why. And you have the trade war, which will probably have some resolution to a piece of it by Christmas just to juice the machine and get you all thinking how great our administration is by the end of the year. So my guess is you'll probably see that continue through till the end of the year. All right, there you guys go. Hopefully I got all your questions answered out there. Let's go to your economic calendar for tomorrow, Friday the 13th. Dun, 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 dun. Oh, that's Star Wars. How does that one go from Friday the 13th, TJ? I think it's like chop, 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 slice, 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 chop, chop. Right? I don't know. I don't know how it goes. Yeah, my movie skills are not so good. Sorry, guys. Friday, December 13th brings us retail sales for the U.S. Now, that is going to show us the previous previous month retail sales numbers. That doesn't necessarily mean it's going to be including all of what we experienced for Black Friday. We'll see how those numbers are. My guess is they're probably going to be pretty good. Anyway, British pound has consumer inflation expectations, and that is it. Quiet Friday. Hopefully no economic nightmares. There'll be no earnings nightmares. The only nightmare you're going to have on, it says Friday, December 9th. Thanks, Mike, for that one. The only earnings announcement you're going to have on Friday, which is going to be a nightmare, is actually pronouncing these names. Why do you do this to me, TJ? I'll do it in my best Dutch. Rustadbiddle is reporting earnings. Yeah, did you like that? The roll the R. Rustadbiddle. Calvista Pharmaceuticals, Virco. I'm guessing that they are from Eastern Europe, comrade. Manufacturing, and what is that? Oncosec Medical. Boy, tough challenge on the earnings calendar for tomorrow. Those are reporting earnings, and it is for December the 13th, not the 9th, as you see on the screen there. Our guest for the show will be the Ambassador of Opportunity, John O'Donnell. I haven't talked to him for a week. We'll see how he's doing, see what's going on out there in the world of the markets with John. And of course, if you guys have something you would like us to address on the show, we would love to hear from you. I appreciate those of you who sent in questions to Power Blast, to the Fuel for Today, also that joined our discussions on our social media channels on YouTube. You guys are awesome. If you like the show, if you like the guests, give us a little thumbs up button out there. If you have comments or questions, you can always write down below the video if you're not watching this live. Always click that link, find out more about Online Trading Academy and how we can help educate you on how these financial markets truly work. Until then, happy trading, everybody. We'll see you tomorrow. Take care.